Hello everyone and welcome back to the Do More With Your Money podcast here at True Potential, your chance to hear more from your investment professionals at True Potential. And in particular, a focus today is going to be exclusive to investment management. We're joined by George, Faye and Paul. We're all aligned with the investment portfolios here at True Potential. And in particular today, we want to look back on quarter two, the exceptional performance we saw across markets there and how it translated into performance for your portfolios. But we also want to keep one eye on the future, in particular the UK budget later this month and also the US election, which will no doubt have profound consequences for the returns from portfolios. So to kick things off, we're going to turn to you, Paul, and let's have a review of the backdrop through the second quarter of the year, which we think contributed to those positive and broad returns.
Yeah, sure. Thanks, Kevin. I suppose it has been a really constructive environment for multi-asset portfolios, and we've seen good returns come through from an equity perspective, but corporate bonds, sovereign bonds, but also alternative assets such as gold. And really, if you think about the economic backdrop, you've seen the US continue to show remarkable growth, and this is nominal GDP, so taking real GDP and inflation, and that's been well above trend and has continued to do so. And it's that real GDP component that has been remarkably strong as inflation has continued to trend lower. Now, why is that? Well, it's really due to the consumer in America. Americans have continued to spend at a phenomenal pace, and that's continued, which has meant that workers have kept within their jobs, and you've seen real wage growth come through as well.
So on that, why do we think, let's just reflect for a bit, why do we think the US consumer has been more positive than, say, the British consumer or the European consumer? What's so distinct about what's happened in America that has set the economy there apart? Because both the UK and Europe and the US are running fiscal deficits, so it's not just borrowing which sets the US apart. There must be something else.
Yeah, I suppose you've seen a lot of investment come through from the fiscal perspective. You've had strong demand. I suppose, following COVID, you had a lot of checks sent out. So you had excess savings.
So this idea of helicopter money, I suppose, where the government actually did send out checks, did actually matter at the start of the cycle, didn't it? That people who were even in work, perhaps, or just received an extra income from the government, which was tax-free, and which they could spend.
Exactly. Some will spend them, but then those that are saving them, because you've seen interest rates go up, but a lot of Americans have very long-term fixed mortgages, 30 years. They've been insensitive to higher interest rates. They've actually earned extra income on those savings that has allowed them to continue to spend and keep that demand high.
And I guess it's difficult to let people know just how big an effect this was, but something we did see was that a lot of people remortgaged in the US at an incredibly low interest rate, probably an interest rate we might not see again in our working lifetimes, and that's just allowed people, as you say, to be completely insulated from the rise in interest rates and actually just benefit on the savings side rather than on their borrowing side.
Exactly, and it's you contrast that with the UK market where interest rates typically mortgage terms are typically 2 years, 3 years, 5 years fixed. US 30 years, completely different. Whereas you've seen that even if you're locked in on a 3-year fixed mortgage during COVID, that's starting to roll off, and you still got interest rates relatively high compared to pre-pandemic.
And do we think there's still a sort of a narrative in the market where investors are surprised by how well the US has done, that there are still people who are out there who have a recession view, and that sort of is still fueling this positive surprise and this idea that equities just continue to outperform and surprise investors?
Absolutely. There's various research providers, investors out there that are using metrics, indicators that have worked in previous cycles that haven't worked in this cycle. This cycle is very atypical, and that's really due to the amount of fiscal spending that has really come through from the government side at a time when financial conditions are loose. Economic activity is expanding.
And that's key, isn't it? So if we can, it's going back quite a bit, but if we think just after the GFC, all the major economies clubbed together and thought we're going to reduce fiscal deficits, we're going to start acting like responsible borrowers. We've not had this time. Now, of course, if governments are continuing to borrow, the people who do benefit are people in work, really, and companies. So that's been another tailwind for the global economy, and particularly the US. It's just governments haven't really looked to decrease their borrowing by that much.
Exactly. And I suppose what's been encouraging is, inflation has been trending towards the Federal Reserve's target of around 2%. We're getting closer and closer, and you're still seeing wage growth coming through, so real wage growth, so people can spend more, and actually they are doing so, particularly in America.
I think that's one of the key things we've been focusing on in terms of the strength of the labour market in the US, which has been sort of the pillar of support throughout the post-COVID picture which we've seen. We saw real challenges of getting workers back into roles after the pandemic, and therefore a lack of appetite to shell workers. So the labour market has been remarkably resilient, and when you couple that with bargaining power, which has led to positive real wage growth, that's put the consumer in a really strong position. And in fact, actually, the labour market is still very strong. You're only seeing it soften at the margin because of increased supply.
And it's a key point, isn't it, that despite a number of consumer and business sentiment surveys being particularly bleak for not just 6 months, 12 months, it's really just translating into lower hiring intentions, not really any intentions to actually take down headcount and sort of start mass redundancies. It's really just being a cooling, isn't it? So what's remarkable.
Absolutely, and that's allowed, the inflation front has given the central banks the confidence to cut interest rates, but they're not expected to cut interest rates aggressively in the near term going forward, because you haven't seen that weakness in the labour market come through. And I suppose the other developments that perhaps we can explore later on is, China. China's really not necessarily turned a corner, but it's the policymakers have been on a united front in terms of trying to address some of the real structural issues that they have within the Chinese economy, and looking to deploy a vast amount of stimulus, which is encouraging for thinking about the global economy. If you've got the two largest countries in the world really doing well and looking to stimulate, that's supportive for global growth.
Thanks for that, Paul, and we will come back to China just towards the end of the podcast. Now, we want to make this about you and what it means for our clients, so we're now going to discuss performance in the portfolios. We're going to discuss up to Q2, so the first half of the year, and that's to do with some of the benchmark data we have available. But George, I'm going to bring you in just to try and give some colour on the performance data we've seen in the first half of the year. We're going to be showing on screen a lot of numbers for clients. It can be quite confusing. So why don't you talk our clients through the top table first, just give the context for the outperformance that we're seeing there for the portfolios versus ARC, and who ARC are.
Absolutely, would love to. So ARC is the asset risk consultants. So we've been working with ARC because they are external, they're independent, they are held to very high governance standards to ensure the accuracy of the data in which they provide, and it's fair, it's comparable, and I think they're all reasonable assumptions to have in place if we're going to compare delivered outcomes. So they are providing data on 140 different investment managers out there. It's a wide universe. It's a lot of the key competitors in which we have within there. So it's fair. It's also fair because actually the information in which they use, they're taking our portfolios, they're deducting the portfolio charge, they're deducting the platform charge, and they are independently assessing the level of risk in which we're taking and putting us in the peer group. So we give them the data, we step back and we wait for the results back.
And so we're not telling ARC where we think we fit in the investment universe.
Exactly.
They're looking at the risk and return profile of the fund, and they're making that deduction for us.
Yeah. And because there's so much data in it, it often takes around 5 weeks after the end of the quarter to be published. So on screen, we can see a table now with a lot of numbers, and this has taken us, as you say, Kevin, to the end of the second quarter. And what we can see is some long-term outcomes, but also some more near-term outcomes, so we can discuss both in context. if we look in the second column since launch in October 15, you can see that we are 9.9% ahead of our peer group average within balanced over that period, which is a good outcome. And what do I mean by good? If we look to the bottom table, that puts us in the first quartile in terms of our competitors out there in the market.
What does that mean? So the first quartile, just for
the top 25%. So if you got all of those managers in that peer group and you took the top 25% slice, we're in that.
So it's not just that we're above average or that we're beating the benchmark, it's we're in the top 25%
exactly.
of performers in this risk profile for a balanced fund.
Yep, independently assessed by another provider there. And we can see this over the last 12 months as well to the end of the second quarter, 1.3% ahead of that average. Now think about that environment to the end of the second quarter. It was quite a narrowly led market environment, technology really driving the returns internationally relative to industries such as materials, industrials. So actually our outcome, which is generally more international, it is more diversified than a number of our peers, through our approach of diversification, we were actually able to provide a very strong outcome. So that approach of being able to get managers in our toolbox who all have different ways of working, different specialisms, but specialisms which we as an investment house can lean into at different points in time, we can see has provided us with pretty consistently good returns above our average in most, and also top quartile.
So
for the majority.
Just let's take a step back there, George, just for a bit, because it's a competitive landscape for our clients to think about where they, not just where they can get their advice, but where they can invest their money. What other competitors are in this basket that we know of? Who are we being measured against? Who are ARC drawing these returns from?
If I put the list on screen, it would blur your eyes, so I'll just call out a few. St James's Place, Quilter,
yep.
Evelyn Partners are in there as well.
So all of the big blue chip names that we would hope to be measured against
exactly.
are in there.
Exactly.
And that's important, isn't it? Because it does show
vital.
that we're a strong competitive investment franchise here. We've got long-term track records here, and that's really what you can see in those first three columns, isn't it? That clients who've stuck with us for the long run, but even clients who've only recently joined us in the last 12 months or so are benefiting as well, not just from markets going up, but our portfolios outperforming versus that benchmark.
And it's got to be a high threshold for us. We want strong competitors in there. So there's going to be some quarters where I'm put this data up and we may not be in the first quartile. We may be more challenged. What I really want to do is ensure that over the long term we've got a high benchmark in order to hit in terms of our competitors we're comparing to, and ensure that we can push ourselves up into those upper quartiles for clients.
And what are the most questions we get from, say, our advisors with regards to ARC? You and I have just been on the road at our conferences there, so we met most of our advisors in either Manchester or London. We had a great time. So what were the most questions you were receiving with regards to the benchmark data?
Well, the first question is who are we comparing to? Yeah. So we covered that one.
So we answered that, yeah.
The second question is how comparable is it from a charging perspective? So our charging is, or the data which we provide here, is net of the portfolio, and it's also net of the platform charge. So we're on a level playing field here, which is important as well. Can they access the information? Well, we provide a fact sheet for advisors to use, which details the delivered outcomes relative to ARC. It gives a bit more context of who ARC are in their methodology around constructing their report, and a bit of commentary in there as well, just to explain what's going on. As we've demonstrated here, we can put a load of numbers up there, but it's important to have a clear understanding as to what's been driving these outcomes.
So in summary, another strong rolling 12 months up to the end of Q2 of this year, a strong 5-year track record, a strong track record since launch in 2015, and that translating into the quartile performances, top quartile since launch and also over the last year, and that's really what was pleasing advisors the last couple of weeks in our discussions. Thank you, George. Okay, so let's bring it a bit more up to date now. So let's go through Q3, really the momentum that's taken us into the current quarter. Delighted to bring in Faye now, so Faye can speak more about our advanced diversification proposition here at True Potential, something that we think makes our portfolios truly unique. The idea that we're employing a number of managers with different investment styles across the universe who can operate at different speeds but are all targeting those positive returns. Faye, could you, if we think about Q3, Could you list for us perhaps a few managers who did well or outperformed in that quarter, and what it was they did that helped contribute to those positive returns?
Yeah, sure, of course. So, as Paul mentioned at the start, returns across the quarter have been really quite broad-based. So you've had equities, fixed income, alternatives, all positive. And that's been a really good backdrop for multi-asset portfolios, which obviously the True Potential portfolios are. So pleased to say actually all the portfolios have been up over the quarter. Some of the top performers, we've had Goldman Sachs Income Builder and also Schroders. They're actually two managers that we have actually increased our allocation to over the year, sorry. So encouraging to see that, managers that we've actively backed and have been increasing.
And two very different styles, isn't it? Obviously,
yeah.
It's in the name, but for Income Builder, I'd focus on generating sustainable income. But Schroders a very different approach, more value focused.
Yeah, exactly. But as I say, you've got those broad returns. So two different managers, but they've both been able to generate strong positive returns in the quarter. Anyway, but obviously for different reasons. So Income Builder, and have an income mandate. So they invest quite heavily in high yield bonds, have a bit less in equity compared to some of our other managers. They're also a bottom up manager, so they invest in more individual securities.
So that's what I was going to say. They're a stock picker, aren't they? So that's their style, is that they're actually out there buying individual bonds rather than buying a portfolio of bonds.
Yeah, exactly. High yield bonds, about 30% of their portfolio, and they've performed really well over the quarter. Another thing that's benefited them is sterling strength. So they actually fully hedge back their foreign currency exposure back to sterling. So that's been beneficial for them as well. And then if we contrast that to someone like Schroders, very, very different approach. So unlike Income Builder, who are obviously more stock picker, bottom up, Schroders are more of a manager of managers. So they invest in active managers. And they're have quite a contrarian approach as well. So they have quite a strong valuation discipline, and that leads them to sort of the more cheaper areas.
So really it takes them away from the US, doesn't it? It's not a market that they've had a high weighting to, whereas other people like Goldman's have had a higher weighting there. So it does set Schroders out as being distinct.
Yeah, they tend to have, obviously with that value exposure, they tend to have more towards the likes of the UK and emerging markets, which are actually two regions that have performed really well this quarter.
And I suppose I'm leading the witness here, but is there any one particular asset class for Schroders which has worked very well? And Paul's already smiling, so he knows the answer. And that's worked particularly well for them over the last couple of years, which has helped them and contributed to positive returns.
Yeah, so they invest quite a bit in gold as well, actually. So they have exposure to both physical gold and also gold mining companies as well. Performed really well over the quarter, and gold miners actually outperformed gold.
So it's terrific for clients, isn't it, that they've benefited really just in these two case studies, two distinct areas. Mm-hmm. Higher yields giving strong income returns, but then gold performing so well in this unusual period of inflation, even as Paul highlighted, inflation surprised to the downside through Q2 and has kept going through Q3.
Yeah, exactly.
So you've benefited there from being in the market. You've benefited from the diversification because of the breadth in different asset classes. But actually under the bonnet, there was quite a bit of divergence between the sectors, business sectors, and how they delivered and therefore investment styles. So the breadth of exposure which we get through our advanced diversification approach, which is the blend of managers with very different disciplines, also enabled us to participate against quite a strong headwind of the currency strength, which we saw sterling appreciating against the dollar by around 5%. That's quite a headwind for a sterling-based investor, and we were able to push through some of that with our portfolios by using a blend of different currency exposures such as dollar, euro, yen, or even, as Faye mentioned, with Goldman Sachs and their approach, which is essentially hedging some of that currency impact out, so your delivered outcome is based on the assets you're investing rather than so much the currency there as well.
I suppose it highlights the importance of active management. We've just listed off a lot of different sectors, asset classes, and you've got very skilled managers looking at these on a day-to-day basis. Someone may have an allocation to gold in their portfolio, but have you considered gold equities? Perhaps not. Schroders have found the opportunity, found an active manager to actually exploit that asset class and have been rewarded for it. So it does highlight the importance.
And George, at the conference when we were speaking with advisors, the bedrock was advanced diversification. So this idea of utilising all the managers and trying to draw out their strengths. But one of the key points we made was that not all of the managers receive the same capital. And this is where we were building out on the skill sets from you all as investors with enhanced implementation. So just building on some of the information from Faye about how we have been adding to some managers, we have been taking away from some managers who we felt would underperform in this environment. Can you help clients understand the journey for their portfolios on those transactions?
Yeah, absolutely. So at a very high level, we've been constructive on economic growth, which has proven to be correct through the information Paul gave there, at a time when we're seeing inflation moderating towards trend. And that's a pretty constructive backdrop for a multi-asset portfolio, an environment where equities and bonds can deliver. And along the way, you can get a greater breadth in terms of the returns. So returns not just coming from one pocket of the market. Nice environment for a multi-asset diversified portfolio. Now, we've been building our allocations through the course of the year into those managers who share that more constructive outlook on equities, and the funding source for that has been the managers who've been more concerned about a negative economic scenario, so more of a recessionary outlook, and because of that they've had much less in terms of the equity allocation which they've held. And that's been the right call for clients. We've taken that decision correctly, and we take these decisions with conviction as well. We want diversification of managers, we want them to be included, but we're going to lean into managers at different points in time because we want to deliver the best outcome for clients. So our bigger allocations at this point are with those managers with larger equity allocations, managers who have been using relatively low levels of cash and using a blend of fixed income and alternatives as well to give us that diversification as and when is required. And we make changes at a portfolio level. The majority of changes which occur actually day to day come through the active managers which we work with, and they've been more interested in certain areas within the market and maybe a little bit faster at acting on this than you could be within a DFM. An example of that, developments within the emerging market space. Paul mentioned a really big stimulus package which was unleashed within China. Monetary stimulus, but also fiscal stimulus, and it's really broad. And I know we've had multiple stimulus packages over the last few months, but this was a little bit different. It was bigger than normal and more targeted, and as a result of that, a number of our managers, UBS, Pictet, even the Growth Aligned team, were quite fast in terms of getting exposure into that market, a market which rallied quite significantly as well. So constructive in terms of the outlook. We're reflecting that within our portfolios and some of the changes in which we've made. So our overweight at this point are to those managers which share that view.
Thanks, George. So that's advanced diversification working well with enhanced implementation. So that brings us up to date with where we got to at the end of Q3. So it's crystal ball time now. So we're going to bring in Faye and Paul again to speak about the immediate outlook. Faye, let's address the UK budget first of all, because that's in the next couple of weeks. How would you characterise the balance of risks here for, perhaps not for UK investors, we're all UK investors, but maybe for the UK assets, say the gilt market or currency?
Yeah, I suppose you wouldn't maybe not expect it to have a huge impact on markets just because markets are so efficient, so they'll tend to only react to news that comes as a surprise.
That's a shock, and we've learnt that the hard way with Liz Truss.
Yeah, exactly. So I suppose we're expecting higher government spending, but and government borrowing to fund the higher spending. But if we see borrowing come in higher than expected, then obviously the government will have to issue more bonds to be able to fund that. So you might see a little bit of weakness in gilts in UK government bonds, perhaps. And
that's maybe what we think we've been seeing the last couple of weeks, although, for instance, UK gilt yields have risen in line with US Treasuries there or thereabouts. So it's not as if the market is particularly concerned at all about the UK. It's perhaps just a global phenomenon where growth is quite strong.
Yeah, exactly.
Yeah, so I guess the risks on the day are if the government pushes too much in the direction of, say, borrowing over taxation, or perhaps leans too heavily on both, and the market just thinks, well, not great for growth, but definitely not great for borrowing. and could be sterling, for instance, that takes the impact there. Okay, so that's the first big event on the horizon, Paul. This is the US election there. So how would we characterise the balance of risks for that?
I suppose the risks, I would say, would be more in the bond market, again, similar for the UK, but the risk is that, well, whether it's Kamala Harris or Donald Trump, neither of them have looked to really consolidate on fiscal spending. They're looking to continue to spend. So, again, issuing more bonds, the risk is that you get a little bit of weakness in the bond market. If Donald Trump comes through, which he's currently favourite in the polls, then he's looking potentially to increase tariffs on Chinese imports, but also imports globally. And additional to that is he's perhaps looking to reduce corporate tax rates. So they're currently at 21%. He's wanting to get to 15%. Whether he'll get that will depend on whether Republicans get the Senate. And so that should be all supportive for the equity market. The risks is that it's a little bit more inflationary, and that comes through in the bond markets.
And I suppose some of the risks for the US in particular might just be that all those interest rate cuts that are expected for next year perhaps don't materialise. But it's more of a pro-growth story, isn't it? And it feeds from Q3, which is we really are enjoying this tailwind from high nominal growth, and none of these policies really at the margins are going to severely impact the growth tailwind that we're enjoying.
Absolutely, I'd agree with that.
And so if we think about some of the themes that Growth Aligned, the fund that we manage internally as part of the portfolio solution, what key themes have we been drawing from there?
Yeah, I suppose there's been three that we've been really driving. That's high nominal GDP, which I talked about at the start. So inflation and real GDP being above trend, that continues to be supported by the consumer and fiscal deficits. Disinflation remains. This is inflation still increasing, but at a lower pace. So if you look at a headline CPI in the US, it's currently 2.4%. So getting ever closer to that 2%, which is allowing central banks to cut interest rates, which is encouraging, especially when financial conditions are so loose. And we've also been playing this theme of productivity, which is really supportive for corporate profit margins looking forward. I suppose what we're really focusing on now, we know valuations in the US are quite rich, so it's really down to corporate earnings now. We're just kicking off corporate earnings season. Started on Friday with the US banks, which actually reported pretty well. And if those earnings come in ahead of expectations, the current bar for earnings for Q3 is quite low, and they actually corporates guide upwards in terms of what they expect in terms of earnings and revenues going forward. That should help multiples derate and should be really constructive for equity markets.
Thanks, Paul. Really good colour on earnings there. That's us near the end of the podcast, but before I let our esteemed panel go, I'm going to put them on the spot with one question. They weren't expecting it, but here goes. Come the US election, George, who do you think is going to win?
I think we're going to see a Republican lead.
There we go. So that's Trump. Faye?
I'll go same.
Trump. I think I know the answer, Paul, but go on.
Well, someone told me recently that when they do the polls, and some people hold back saying that they're going to vote for Trump. So at the moment it's 50-50 in the polls, maybe slightly edging towards Trump. So I think there's going to be a Trump win.
Trump, okay. I'm going to be different. I think it'll be Harris, but it may not actually be clear on the day. So the news there, if we sum up all of that economic content, is that so far it's supportive for nominal growth. That's a theme that we've certainly been feeding into for the last 2 years here at True Potential Investments. Government support is likely to continue. No government is really speaking about fiscal consolidation, and that's coming through in the market performance we've seen, where equities and bonds have had exceptionally strong years, and even those alternatives that Faye spoke about, gold and other types of strategies. So that's all for today. We hope that's been useful. It's the first of our deep dives into performance data. We'll hopefully be able to do another one say in 4 to 5 weeks when some more data is made available to us. But that's all for today. Please do like and subscribe on the YouTube channel. Please do join us on the morning markets, where we always update you on the events of the day and what we think is driving daily market movements. So that's all for now. Thank you and take care.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.